First, I will start with disclaimers. Since this is a year-end webinar, by the way, it will be a little bit longer on the presentation side. I promised you that when the prior webinar was a little bit shorter. So disclaimers. This is not a solicitation to buy or sell any security ever. In fact, this is not advice. The results here are provided for general information purposes as a convenience to you, the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Here is the agenda. We'll have an economic update, a market update, a reinforcement of my view of ChatGPT, a topics discussion of 2023, and a summary. And we're going to go so fast that we just finished the agenda slide. Here is the economic update. It will be a bit different than what I have done before. Far fewer nuts and bolts inside inflation indices and much more about the inflation indices because, as far as I'm concerned, inflation is over. I still believe, wholeheartedly have believed and will believe till the day I die, that an irritant was introduced in 2020. We called it COVID. And there were fiscal reactions to it. They too caused irritants. That irritant or those irritants wreaked havoc on our collective and personal psyches. It also wreaked havoc on our economy, jobs, inflation, GDP, both due to it in and of itself, but also the follow-on fiscal policy. So there was an earthquake in 2020. But the further we get from that irritant, the further we get from the earthquake, the less irritated we are. That's both in the market, the economy, and in our lives. The economy has recovered beautifully. Inflation is in free fall, unemployment is remarkably low, and the job market in general is robust, while real wages, that's wages after inflation, are rising, and they are the highest ever. At the same time, the discombobulated behavior has eased. Quit rates have chilled out. People aren't just quitting and getting jobs for twice the pay. Goods buying, chilled out. Stay-at-home behavior, chilled out. Supply chains, back to normal. We see this in all the data that I present to you in the dossiers and prior webinars. Right? But we're also finally starting to see it in sentiment. And no, things aren't as bad as they seem in a vacuum. But we don't live in a vacuum. Our health, both mental and physical, must heal from the pandemic itself. The further we get from the irritant, the less irritated we will be. It's this period, the after this period, where investors should be looking. That is where I am looking. That's where money is made and lost. You recognize the irritant, identify the impact of the irritant, and allow perspective to accept the end of that irritant. You need all three. If you have only two of those three or none of those three, you will not make it. Just these three things could make you angry. What I just said could be making you angry. Have patience with yourself. The irritant is fading. Now is time to receive that reality. The trauma is ending. Now care for yourself and others. It's this after this period. That's why we have a list of top picks. This is why I speak with CEOs and then share the conversations. It's because I'm looking at the after this period. Lastly, if conversations like this make you angry, that's okay too. Letting go of pain is hard. And in fairness, oftentimes trauma stays with us a lifetime. It's unfortunate, but it's true. But while not to make light of what happened during COVID, you are here to hear what I have to say about the market and the economy, and therefore I will move there. And I hope you do not feel that me moving to those subjects is somehow insensitive. That's my job. All right, inflation and the stuff impacting it. Short version. But first, I said last time that I had shifted from inflation is the only thing that matters to a slight change. What the Fed thinks about inflation is the only thing that matters. And I was right. And now the Fed thinks inflation is coming down too. And how do I know that? Because at the last Fed press conference, after the Federal Open Market Committee, we got two changes from Chairman Powell as the mouthpiece for the FOMC. Number one, he said, or did not say, that below trend growth would be needed to lower inflation. He had said that every single press conference after FOMC meetings up until the one we just had in December. He didn't say it. The second thing, the committee will cut rates even if inflation is not at 2%, so that the real rate of interest, which is the interest rate minus inflation, does not become too restrictive. I said what the Fed thinks about inflation is the only thing that matters. The Fed thinks it's coming down too, finally, and I'm going to show it to you with actual data, not just words. So here are some measures of inflation that we track. There's 6 inflation indices. Okay, and I'm going to tell you the difference between two of them, kind of the internal plumbing of inflation. First, this is CPI. Okay, on the top we have headline CPI, and the bottom we have core. Core is CPI, excluding food and energy. 4 webinars ago, CPI was at 6%. It peaked in the 9s, but I'm just talking about this year. We were at 6%. We did a webinar. It's down to 3.1. Core CPI 4 webinars ago was at 5.5%. It's down to 4%. This is PPI. It's the Producer's Price Index. It's like CPI, but for wholesalers. So CPI is for consumers, and PPI is for producers. In general, we like to think that where wholesaler inflation goes, so goes consumer inflation. PPI was at 4.6% year over year 4 quarters ago. It's under 1. Core PPI was at 4.4% 4 webinars ago. It's at 2%. That's the Fed's target. But the most important ones are the PCE and core PCE. I'm going to show you the numbers and then tell you why they're different than CPI. Okay? Kind of the internal plumbing. Core PCE is the Fed's preferred measure of inflation. It was at 4.6% 4 webinars ago, and 3 webinars ago, even though I was saying inflation was coming down, it had not changed. It was at 4.6 and it stayed at 4.6. It has now plummeted to 3.2 in 3 reports. That's like a 3 standard deviation move coming down that fast. Okay. And PCE, which is core PCE, but with food and energy, is down to 2.6%. Remember, this is the Fed's preferred measure. Before I go on, the question you might be asking is, why is this personal consumption expenditures inflation lower than this? Okay, here's some internal plumbing. Ready? CPI measures the price of a relatively fixed basket of goods. That doesn't have to make sense right now. I'm going to give you an example. PCE measures the price of things people are actually buying. Okay, I'm going to give you an example. Let's pretend prices remain completely steady for a full year. All prices, everything, from a battery to cars. But all of a sudden, the price of bread went to $1 million a loaf. Just bread. It was just bread. Just bread went to $1 million a loaf. Okay, CPI would skyrocket because bread is in that basket of things they measure. But in reality, nobody would buy bread. They would just buy rice or tortillas, right? So PCE in that case, since people would not be buying bread, would be unchanged. Right? So that's the difference. CPI looks at prices of a basket of goods that are fixed. PCE actually comes from the GDP reports, what people are buying. So it's more important that PCE is at 2.6% than CPI is at 3.1%. But they're both important measures of inflation. But there's a reason the Fed has a preferred measure. The Fed cares about what people are actually spending on. The price of things you and I are spending money on. PCE is at 2.6%. Inflation is dead. Some other ways to look at these inflation measures. The Cleveland Fed has something they call the nowcast. It's updated every day. It's algorithmic. There's no human beings. It's a forecasting model for inflation. Okay. And in the nowcast, we see 2 things. First, throughout this quarter, the model kept lowering forecasts as it was receiving more and more information. And here's how it looks. Okay. This is as of December 7th. Just see where, so this is PCE, core PCE, CPI, and core CPI. So the 4 of those 6 charts I showed you, this is the inflation. You can pick any color and see where it started and ended, right? It's all going down. So as of December 7th, as new information was coming in, the nowcast was going down. But look what happened as of December 25th. We had this monstrous drop. I'm gonna make these images bigger. So this was the trend through December 7th. Then on Christmas, it totally and utterly collapsed. I'll make it even bigger. Inflation is coming down faster than the Fed anticipated. It's faster than even algorithmic models can anticipate. Something is changing. Remember, these are not human beings. This is algorithmic. I'm going to show you what the Fed thinks in a second. And to show you how it's happening in another way, core PCE, the Fed's preferred measure of inflation, this blue line year over year, is at 3.2%, right? And the target is 2. But if we look at the 6-month rate annualized, it's already below 2%. And we look at the 6-month rate as a measure of where it's headed. Right? Okay. Now I'm going to show you what the Fed thinks. In September, in the press conference, the Fed said they thought GDP in Q4 will grow 2.1%. Just 3 months later, it's now 2.6%. That's actually from an Atlanta Fed nowcast. The Fed said in September that the year would end at 3.3% PCE. It's already at 2.6%, and we don't have the December numbers yet. Those come out in late January. The Fed said in September, we think core PCE is going to be 3.7%. Just 3 months later, we're at 3.2, right? The Fed thought this number would be 3.7. That's what this means. Inflation is collapsing. This is irrespective of oil. And then we have some Fed funds rate information. The Fed thought they were going to be raising again. They realized they will not be. The Fed thought, as of September, the Fed thought at the end of 2024, rates would be at 5.1%. Now the Fed itself thinks it'll be 4.6. The Fed itself is pricing in 2 or 3 cuts. I'm not talking about the futures market. I'm talking about the Federal Open Market Committee. So I'm going to just take a snippet of a slide from earlier. I said what the Fed thinks about inflation is the only thing that matters. I was right, and now the Fed thinks inflation is coming down too. Here, see? The Fed thinks inflation is coming down too. It's not what Ophir thinks. This is what the Fed thinks. Okay. And it wasn't just inflation. It was GDP. I'm going to show you a chart from Joseph Politano. This is going to be a chart of what the Fed thought GDP would grow in 2023, going back in history. So this is all for 2023. This is what the Fed thought. Oh my gosh, GDP is going to collapse. And here it is. And I want you to notice something. If the Fed would have just shut their mouths, they were dead on the money. They were right in 2021. They were right in halfway through. They were right in 2020. They were right in September of 2021. This is exactly where GDP is. All of this is what gave us all heartburn. This too. This too. You can go all the way back to the end of your webinar for 2022. And I said the Fed's expectations, the median expectation for core PCE inflation is too high. It doesn't make sense. And I was right. How is inflation coming down? Whoa. All of these things, I call it disinflation station. Japan is in disinflation. It's not just the US. Eurozone is in disinflation. The UK is in disinflation. Rent is in disinflation. Food is in disinflation. Services are in disinflation. The labor force participation is back. Prime age labor force participation is almost at all-time highs. Job openings are falling. Payrolls are falling. Wages are in disinflation. I think I said that twice. Consumer savings are down. I'll show a chart of that. Bank risk is still elevated. Credit card spending is down. I'll show a chart of that. And all of the inflation measures I showed you, those six measures, they're all coming down. So this is what I think. I think history is going to record that those who believed in the transitory nature of inflation, while we underestimated the duration of that transitoriness, were essentially correct. Remember when I spoke about identity economics? I said this way back in 2021. And I said, there are some very influential people who have staked their reputations on the idea of hyperinflation. They also staked their wealth on it. And further, that they would fight tooth and nail to the death, I said, I was being colloquial, to defend that idea. And I told you, I got, I don't know, maybe 300 emails. People said, who? And I said, I don't want to say who it is because they're going to harm our business. Well, that person no longer can harm our business. That person was Jack Dorsey. He said in October of 2021, hyperinflation is going to change everything. It's happening. He said, and 25,000 people retweeted that. He said it will happen in the US soon, and so the world. And then later on, he said those people who believe we won't have hyperinflation are the same people who believe in Santa Claus. Remember who you're listening to if you're listening. Jack Dorsey is a magnificent entrepreneur. He knows nothing about economics. He put a monstrous bet on Bitcoin. I mean, a monstrous bet on Bitcoin. And he needed this to happen. This was his identity. He would defend this to the death. And now nobody gives a shit what Jack Dorsey says about inflation. So I think people will, it will show that it was transitory in nature, although far longer. That transition was far longer. The irritant, the situation, was intrinsically temporary. Right? It extended over several years, and it all unfolded due to the pandemic. Ultimately, this will lead to, hopefully, not guaranteed, a gentle resolution, primarily because of the pandemic's impact. But we cannot have a Fed that is overly reactive to the past. We cannot, and they have been. Right? I showed you that picture of their forecasts when they really should have just stuck with their forecasts. The Fed's tools operate with a lag. The Fed must be more strategic, less reactive. And as I said 9 months ago, if the Fed continues to signal hopelessness, the market will oblige. That's what we saw with the SVB and FRC bank collapses. The Fed is being a little less hopeless now. Remember, I called out Neil Kashkari. I said that guy, the words coming out of his mouth could cause a disaster. And that he was not only wrong, he was dead wrong. 2, 3, 4 standard deviations wrong. I was right. He was wrong. The Fed's impetuous language could undermine the standing of the entire global financial market. They could bring the whole fucking thing down. Remember this? This is impetuousness. The Fed can still break something. So while I sound optimistic, that does not mean I am not cautious. I think there's still a reason to be cautious because of what I just said. The huge Q3 GDP numbers were driven by households and a lot of government spending, and the government spending part doesn't really recur. Households, their credit card delinquencies are rising. I told you I'd show you a chart. Here it is. This is the kind of chart Jack Dorsey would show you. Like, look, we're going into a massive recession now. Look at the hyperinflation or hyperdisinflation or something. But that's not really the chart, right? This is the chart. This is the same chart. This is right here. So yes, credit card delinquencies are rising. I'm not saying they're not. I'm telling you, I'm partially cautious because of this. I'm not sticking my head in the sand. I'm just saying when you look at this chart on Twitter, what you're really doing is making yourself dumber. So don't make yourself dumber and get off Twitter. I said the savings rate is dropping. It is, but I mean, it's kind of long-term trend. Savings rate, it's dropping, right? Sure, that's all the money from fiscal policy, blah, blah, blah. It's true. I thought it was a bigger deal than it was. And then after the after the third quarter webinar, I read some papers and I was like, yeah, I think I overstated it too. People are making money. Real wages are higher. As you can see, savings rates are going up. People aren't just spending money because they got flush with cash. They're actually spending money because they're making more money than they ever have. More people are making more money than ever before in the United States. That's just the truth. How it's not causing inflation, I have no idea. So I think while I'm cautious, right? So I'm saying I'm cautious and I'm giving you reasons why the GDP numbers might be a little bloated. I'm also telling you any reasonable and unbiased person would say this, while noting those risks, that 2023 has been inconceivably good for the economy. It's just completely inconceivable. In fact, I know a reasonable person who said that it's inconceivably good. And then I tried to explain it. And that was on December 22nd. You can both be cautious and recognize that it's been inconceivably good so far. So far. Right? Now, in 2023, I thought we were going to have a recession if the Fed followed through. And the Fed did follow through, in fairness. They did. In 2024, there's more evidence to support that next year will be good than it will be bad. But I still think there's reason to be cautious. And one last thing. If you're sitting there and you're thinking to yourself, inflation is going down, not where I live, bruh. Not where I live, bruh. Let me show you why you feel that way, because you're right. But so am I. And this is where there's a disconnect between what people experience and what economists look at. Okay, this is it. These are the prices of new cars and used cars. This chart doesn't show you much, so I'm going to mark it up. Okay. If you look back in 2020 and look at the circles, just look where prices went. That's a huge amount of inflation. A huge amount of inflation. Look what these were headed at. Look at this. Look at the used cars. Should be what, around here? Huge inflation. But that's not what economists are talking about. It doesn't mean you don't have to pay more for cars. That's true. But this is what economists are looking at. Right? It's this. In the last year, it's flat to down. So I'm just going to keep the arrows. This is what we feel as human beings since 2020. This is what economists are talking about. Just so you know, where is the disconnect? How can inflation be coming down when you look around and you're like, dude, the prices are huge. They're both right. The arrows are big, but recently the arrows are small. And economists look at the last year. Fair or unfair, I'm just trying to connect your feelings with what you're seeing in the headlines so you don't feel crazy. I don't want you to feel gaslit, basically. Okay. All right, that's the economic update. I told you I wouldn't go too far on that. Now the market update. This is the S&P 500, and it has gone nowhere for 2 years. It just hasn't. So when people say we're overbought, maybe we are. When people say evaluations are stretched, depends on how you look at it. One thing that they say that is wrong, they say the market has gone too high too fast. Wrong. It's simply wrong. Get off Twitter. The market has not gone up too much. We are exactly where we were 2 years ago. So that's simply a false statement. Does that mean the market can't go down? No, the market could go down to here. But what you're going to get on Twitter is a lack of perspective. You're going to get Jack Dorsey. You're going to get that chart I showed you of delinquencies because it's just more engaging. And to tell you the truth, I don't actually think people are trying to trick you. I think they're just stupid. I think they're uneducated, don't have a background in economics, don't have a background in finance. They feel like it's an easy subject, unlike being, let's say, a doctor. And so they share things which sure look good. But it's just as dangerous as having a heart surgery done by me. If I'm doing your heart surgery, you're going to die. You would never go to me for heart surgery. So why would you go to those people for a take on finance? What is the disregard for people who have worked in finance for 25 years or economics? I don't really get it. That's your call. That's the S&P 500. This is the equal weighted S&P 500, which is actually down over the last 2 years, right? So a lot of this, even this part that's above where it was, that's just, Apple, Microsoft, Google, Amazon, Tesla, NVIDIA, and some other Magnificent Seven, I can't remember. So the equal weighted is actually down. So we can say safely that the market is not stretched relative to its past. That doesn't mean it won't go down. I'm just saying it's completely disingenuous. And I just want to say one more thing. Even if the equal weighted market was where it is, or the S&P 500 where it is, keep in mind that this is not inflation adjusted. We've had about 22% inflation. So if the market was 22% higher, it would have just gone with inflation. So we are lower in real terms than we were. Like we're like down here. There's no version of the world we're looking at a chart of the S&P 500 that we're stretched. We're just not. That doesn't mean we're going to go up. It's just a foolhardy analysis to say that we're stretched because of this chart and only because of this chart. All right. So is there evidence of money ready to come into the market? So year to date, this is from Goldman Sachs. There's a lot of money in money markets. It's negative. This is negative. 14 trillion in equities. But I think there is evidence that money's going to come into the market. And here's data from December 7th through December 20th. First, we saw the largest daily inflow ever on December 15th, ever in the history of our country. In the week that ended 12/15, we saw the largest weekly inflows ever. It wasn't just a day, it was the week. That same week ended, we saw the largest weekly inflows into RSP, which is the equal weighted S&P 500 ever. We saw the highest daily call volume in the Russell 2000 ever. Saw the largest weekly inflows into credit, basically, in the last 2 years. So there's money out there that could come into the market. I'm not saying it will. In no way am I now telling you this money is going to the market. That is not what I'm saying. I'm saying, is there evidence that perhaps money could come into the market? That's all I'm telling you. I'm giving you facts ABC, analysis ABC. I haven't even drawn conclusion ABC. These are simply facts. All right. Last time, I said, what's happening now is exactly what we thought would happen. Remember, people were freaking out just a little bit, and then they really freaked out. Market seasonality is playing out almost perfectly as Wall Street feels discomfort. These slides are straight up from, like, I literally copied these slides from the last webinar. I sent an alert on August 16th. I said, risk alert, that time of year headlines get a little weird. I even wrote here, it's that time of year. As the calendar turns to the back half of August and into September through Nov, the market just gets a little weird. News will pop up that in retrospect isn't really new, in that the data or events were well telegraphed, but what's new is the focus on them. I said, welcome to that time of year. And yes, the phrase deserves capital letters. That time of year. Said we're going to see headlines surrounding China. Yep. Said we'll read about Fed minutes in various speeches. Yep. I said we'll read about possible recession. Yep. I said we'll read about credit issues and borrowing costs. Fitch downgraded the U.S. sovereign debt, but the issue goes beyond national ratings. I said other stuff that's just going to feel like the world as we know it is ending. A war in the Middle East. Right? But here's the thing. It doesn't really matter if those things come true. Pessimism means the market goes down. And that's why, in general, the market goes down in that period of time. Headlines covering the same news, they simply skew more negative. After all, those are mostly written by humans. And like all of us, we all get a little sad right now. Not right now, back then. And the proof is in the pudding. This is what the market did. Webinar was around here-ish. Right around here, I said this. It's that time of year, headlines get a little weird. It was in this period that several people in CML community started saying, I'm done with this. I can't invest. CML Pro sucks. Lots of bad things about me personally, whatever. And I just let it go. I said, okay, just calm down. We've had like a couple hundred of those people resubscribe. And why is that? Because of this. That's what happened after. That's what I said. That's generally what seasonality happens. That's generally what happens. I said in community, this should not be a surprise. All of this shouldn't be a surprise. This is what long-term investing is. And in reality, this isn't even long-term investing. This is 6 months. This is 6 months. This isn't long-term investing. So since my words don't seem to ring true, I'm going to borrow from Morgan Housel. The next 4 bullets or next 4 things are from Morgan Housel. I will give him credit at the bottom. I just don't want to repeat his name 4 times. So these are not my words. These are Morgan Housel's words. I'm not stealing credit. He said, the long run is just a collection of short runs that you have to put up with. So saying that you have a 10-year time horizon does not exempt you from all of the nonsense that happens during the next 10 years. Everyone has to experience recessions and bear markets, the meltdowns, the surprises, and the memes at the same time. So rather than assuming a long-term thinker doesn't have to deal with nonsense, the question actually becomes, how can you endure a never-ending parade of nonsense? Long-term thinking can be deceptive safety blanket that people assume lets them bypass the painful and unpredictable short run. Wrong. It never does. And it never will. It might be the opposite. Being a long-term investor is actually harder than being a short-term investor. The longer your time horizon, the more calamities and disasters you'll experience. Russia invaded Ukraine, war in the Middle East, COVID. So this is my question to you, and it's an honest one. If the last 6 months were too much for you to take, and you threw histrionics and community, then I want you to hear me very clearly. This is not for you. And by this, I don't just mean CML Pro. I do mean CML Pro, but I mean more than that. The stock market is not for you. This chart is not of a stock. It's of the S&P 500. So I can't say it's just index investing. This is the S&P 500. I'm not showing you like a top pick. This is the large cap index of the United States. If this is too much for you to handle in 6 months, get out of the stock market. There's other places you can be. This is not a badge of honor. Some people like to skydive. Some people don't. The people who do or don't aren't smarter than the people who do or don't. The people who do or don't have a badge of honor. Some people like the thrills, some people don't. That's the stock market. If you don't want to skydive, don't skydive. But if you are going to skydive and you don't want to, don't halfway down start throwing insults at the instructor who's got you buckled to him. You jumped. All right, so what do I think about 2024? Some thoughts. I think the bullish argument for 2024 should be that rates come down slower than futures reflect. Futures reflect like 6 or 7 cuts. I don't think that's bullish. I don't think that's good. I think we only get there if we hit a recession. So what I think would be great was we see maybe 2 or 3 rate cuts later this year. 3 rate cuts would be like Goldilocks. That'd be awesome. It'd be great. Not 6 or 7, 2 or 3. Actually, right on the Fed's prediction. Let's see if the Fed starts changing their predictions. It's not really a prediction. It's the median dot plot. It doesn't matter. I'm calling it a forecast. I'm not going to split hairs. This would indicate both economic resilience and continued disinflation. So the Fed would cut rates because we're getting disinflation, but they're not cutting rates too quickly because there's no need to. The economy's doing well. I think this is the Goldilocks outcome. So far, we have reached the Goldilocks outcome. Unfortunately, even if we were not going to hit the Goldilocks outcome, we would have to come here anyway. We were going to get here almost no matter what. The question is, what happens next? I think a recession is possible, but less likely. Last year, I thought it was really likely. That's good. I'm glad that I think it's less likely. That doesn't mean I think it won't. It's impossible. I just think it's less likely. Any reasonable person would say the same thing. I think it will be volatile, though, because CEOs and CFOs have told me it would be. Remember what they said to me, and I told you? By the way, that's what long-term investing is. They told me, hey, Fear, it's really hard to forecast a quarter ahead. It's like, oh, okay. All right. I think it was like Globally who told me that. And then I think DigitalOcean told me, they're like, it's hard to forecast a month ahead. And then I think it was the trade desk said, actually, it's hard to forecast, and CrowdStrike said, I think it's actually hard to forecast a week ahead. Okay, if these companies can't even see a week ahead, it's going to be volatile, and it's not their fault. But I stand by the first material statement I made today. An irritant was introduced in 2020. It was COVID and the fiscal response. But the further we get from the irritant, the less irritated we will be. Predictions and forecasts will get more and more accurate. We're just going to have to get further and further away from COVID, and we are. And I'm focusing on after this. But I don't even know if we're in after this yet. Like, are we here yet? I actually don't know, guys. If I knew, I would tell you. Like, have we landed? Is it Goldilocks, or is it Goldilocks? Does it look like Goldilocks, but it's a head fake? We'll have a recession? I don't know. Either you choose to have a portfolio where some of the risk is in volatile assets. That's, in this case, we're talking about stocks, but there's lots of volatile assets. Or you do not. And remember, this is the S&P 500. This isn't top picks. I'm not showing you what a tech stock looks like. I'm showing you what $40 trillion in market cap looks like. And that was just 6 months. So either you want that or you don't. It's not my decision for you. It's my decision for me. I decide for me. You decide for you. Is this for you or not? This is only 6 months. Own your decision, respect and honor yourself. This isn't for everyone, just like skydiving isn't for everyone. It's not a judgment or a sign of bravery or intellect. It's just a thing you can choose to do or not. That's all it is. But don't pretend that you're okay with it and then come back and not be and scare everyone else. That's disrespecting yourself. You're better than that. You help people. Your life matters. You help the people around you. Maybe you just pick up a Coke can that someone missed when they threw it away in the garbage. They didn't mean to miss the garbage, but you just quietly pick it up, throw it away. Maybe you give someone a little extra time to cross the street. Or maybe the things you do are far clearer. You're a parent. Take care of a grandparent. Maybe you're a grandparent and take care of grandkids. Maybe you're just good to your neighbor. Maybe on your walks, you just say hi to people. At the grocery store, you're nice to the cashier. You're all good people. And the way you get out of being a good person is when you put yourself in positions that you think you want, but you don't. So don't do that. This is a choice. No one is forcing this upon you. There's no force here. This is of your own mind. Just own that it's of your own mind. All right. I'm going to talk about ChatGPT. This is exactly what I said before, and I think I will be saying this probably for the next 5 years. So if you don't like this part, that's okay. Don't watch the webinars. First, the opportunity. Much more code will be created, and it is happening. This is not a 5-year thing. This is a right now. Because of that, more infrastructure will be needed. And because more infrastructure will be needed, more semiconductors and tooling will be needed. And because of that, more use of platforms and infrastructure will be needed. I said infrastructure twice. Then more infrastructure observability will be needed. So that's software that looks at your infrastructure and tells you how it's going, right? And that means you're also going to need to look at your application performance monitor, right? Like how is the software that's running on your cloud doing? And that means you're going to have to have more source code management needed, right? Like there's all this code, right? I'm basically naming top picks here, right? And more data will be created. An extraordinary amount of data. Whatever the highest estimate is of data, my guess it will be 1 million to 1 trillion times bigger. It's completely misunderstood. We will need to be storing data on glass because the world won't have enough electricity to store the amount of data that's going to be created. And it's okay, Microsoft is doing that. And by the way, you have all this stuff, you're going to need more security. Which top pick is that? And a lot more products are going to be created. But which top pick does better when there's more products created? And it's going to be more advertising because of that. So more products, you got advertisement. And which top pick is going to do better because of that? I've seen hype and overhype. And this isn't. In less than 2 years, and I said this 6 months ago, so in less than 1.5 years, companies not using ChatGPT or some LLM, doesn't have to be ChatGPT, could be run over by current competitors and new entrants. I believe companies that are worth billions of dollars in 2 years will be worth $0. Companies that have 5,000 employees will have 0 employees. And the risk. This is totally hypothetical. It's a supposition. Let's say 5 software companies compete today and keep prices semi-competitive, but yield high rents in an area, say part of DevOps, maybe infrastructure observability. This would be like Datadog and Splunk, stuff like that. Totally hypothetical. It's not a prediction. Just it's my job to give you risks too. So a risk is bad news. Okay. And all of a sudden, within 2 to 5 years, I would say closer to like 6 months to 2 years, maybe 10 different people create the same thing 10 different ways using ChatGPT plugins and just text or whatever LLM. In other words, they write in text the thing you want done. Like they write, observe and report, fill in the blank infrastructure observation. They literally just write it like text. Hey, I'm in AWS and I have EC2 instances and I want to observe all of my infrastructure. They just write that. Bam, code is written. You just go down the list of text, right? You look at companies and they have a list of all the things they do. Those things, those documents, which kind of describe what a company does, I think those are basically going to be how companies go out of business. Because you do is you copy and paste it, put it into an LLM, it'll write the code. Not that simple, obviously, but you get the idea. Connect ChatGPT to whichever API or hardware is in the cloud and no overhead, no legacy tech. Perhaps you're not even trying to make profits, no employees, maybe make it free, or just compete on price with thousands fewer employees, perhaps just one person in a home office. Maybe Datadog sells something for $2 million and you sell it for $2. The whole thing comes down. This is the catastrophe risk. I don't think this is going to happen, but I make that very clear later. But this is like the catastrophe risk. This is the risk that we see 80% unemployment. And that's in 2 to 5 years. In 5+ years, it'll be millions of people doing the same thing in every part of software and every non-real world service. It just will be. Or, less catastrophic. Perhaps large enterprises simply kind of flip back to build rather than buy, right? Build their own software rather than buy it and use their own dev teams to replace expensive enterprise software. In fairness, this is really the risk I'm talking about, not like the catastrophe, okay? The decision to build rather than buy is the risk I'm most focused on. Having said that, I think the opportunity is greater than the risk, and there's many reasons. First of all, open source software is available now for most things that are occurring on the cloud, from observability to application performance management, and most things in between. And the truth of the matter is enterprises prefer managed solutions. They just do. There's a lot of evidence that even if there's more product, it won't change things. Certainly won't be a catastrophe. And this is where we're going to look. The enterprises whose managed solutions are so good that people will not go to something free. You might call that an after this winter. Companies that fit into the opportunity space in that long list I showed you that are also managed solutions. And here we go. These are not new top picks. It's the same list of companies I showed you before. We have lots of new members, so I like to repeat it. These are companies that fit into the opportunity areas that I identified, those long bullet points, right? There will be more opportunities. There's going to be more companies. This is not complete. There's going to be more companies. I just want to share the process with you, okay? These are not new top picks. Man, Ophir added 30 new top picks. No, he didn't. These are not new top picks. He did it in red font. Okay, that's the opportunity. So who does that? Blah, 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 blah. I'm going to discuss overarching risks. But first, when I talk about after this winners, maybe I should define it. So an after this winner, the winners will be those companies that have domain expertise. They can't be domain generalists. Domain expertise. So they're experts in a thing. And they dive headfirst into new capabilities enabled by ChatGPT or other LLMs. It doesn't have to be ChatGPT. Okay. In our view, there are two versions of any company as of a few months ago. I told this to CNBC. Here's the two versions of companies. You ready? Number one, those with domain expertise and go all in on LLMs like ChatGPT. They're going to be awesome. And then there's another kind of company, and the other kind of company will not exist. There's two kinds of companies, the people that do this and the people that don't exist. Don't invest in the second type. I'm going to try my best with top picks to avoid these companies. I will not avoid all of them. But that's why I've been so selective. And after this winner is the former. That's implicit in the word winner. And not after this winner is the latter. It's implicit in the statement, not a winner. That's it. There are many people who invest a lot of money, are managing money, and you've seen things like, we've seen AI before. This is no different. I can tell you as an AI expert, as an AI, someone who's coded AI, someone who's been celebrated for his AI, someone who's been published for his AI, someone who ran a hedge fund on AI, and someone who spoke at the main stage in the stadium in CFA conference on AI. Someone who has a patent pending on AI. They're wrong. I'm right. I'm right. I don't know I'm going to be right about the top picks. I'm right about the impact. Within obviously there's a band of truth. There's a band of how right or wrong. The people who say, gosh, there's been AI before, this is no different, run screaming. They're wrong. I can't give you 2 graduate school degrees of knowledge and 25 years of experience in a webinar to tell you why they're wrong. I've done my best to do so in a full few bullet points. You can read about it yourself. The people who say there's no difference between this AI and other AI, blah, 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 they're wrong. We've named 9 such winners. Let's talk about them. So far, of course. Okay, the summary is this. What the Fed thinks about inflation is the only thing that matters. An irritant was introduced. It was COVID. But the further we get from the irritant, the less irritated we are. History is going to record those who believed in the transitory nature of inflation while underestimating the duration were essentially correct. That's my view. The Fed can still break something, may already have. And I think there's still reason to be cautious. Having said all that, any reasonable and unbiased person would say, while noting the risks above, that 2023 has been inconceivably good. It's just the truth. More people working than ever, making more money than ever. We drilled more oil in November than any country has drilled ever in the history of the world. The record we broke was our own record in October. It's just been an unbelievable 2023. From drilling more oil than any company has ever drilled ever in the history of the world in back-to-back months to the performance of the economy. Good for us. This is still a unique opportunity to see which companies or businesses, not necessarily stock prices, will outperform. There's still difficulty. Remember, when CEOs are telling me, hey, it's tough to see quarter to quarter. Actually, it's tough to see month to month. Actually, it's tough to see week to week. It's going to be bumpy. All those charts I showed that look like V's, they could be upside down V's. It's going to be bumpy. By no means do I mean to tell you that I think 2024 will not be bumpy. It's going to be bumpy. But it's from that we find the after this winners. The companies their businesses are performing better than others. The stocks might be down 50%, but you look at the business and you say, wait a second, they're winning market share. Bumpy, but worth it. But in reality, that's what I think. Worth it is your decision. It's worth it to me. It doesn't have to be worth it to you. That's your decision. I cannot be any more clear. I cannot present any more transparently the decisions you make if you want to invest in the stock market. And I was just talking about the S&P 500, not to speak of individual tech stocks, right? So if you didn't know how volatile the stock market was, well, you do now, and this is your decision. Hopefully a few new top picks on the way. After this winners, I've been cautious because to tell you the truth, there is one company, other than two companies, I haven't seen absolute evidence that these companies are picking up market share in a manner that is because of the way they're approaching AI. There are 2 that I think have, and I'm actually talking to a couple of hedge funds about it.